This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 4 videos on major trend reversals. I'll begin by distinguishing a major from a minor reversal. Next, I'll make the point that a major trend reversal is the most important reversal pattern. Most reversal patterns involve trading ranges. I'll begin by talking about major trend reversals. And throughout the course of the next several videos, I will talk about the other types of reversals as well. Here we have a bull trend, and when the market's in a bull trend, traders assume that every reversal down will be minor and form either a trading range or a bull flag, and that the bull trend will resume. Here we have a break below the bull trend line, the bottom of the channel, and we have 5 out of 6 bars having bear bodies. It's not all that strong on the part of the bears. However, there's enough selling pressure here for traders to think that perhaps, yes, it's a minor reversal, but once the bull trend resumes, there's an increased chance of a major trend reversal. And this is true especially because of a wedge top. 3 pushes up, 1, 2, 3. Yes, minor reversal. You expect the bull trend to resume. Some traders will sell below this bar. Other traders will wait until there's a strong bear breakout. Here we have 3 consecutive bear bars with good sized bodies, and then they'll sell here, looking for at least a couple legs down from there. Minor reversal. The bull trend resumed, but it did not get very far, and it failed around the old high. Head and shoulders top. Expect a second leg down. Wedge top. Expect at least 2 legs down, 1 pullback 2. Traders will sell below here, either for a swing or simply for a scalp down for a second leg. Strong bear breakout. At this point, the market's always in short by the close of this bar, and the odds are we're going lower. And it looks like this is probably going to be a major reversal and go down for at least another leg or 2. Some traders will sell here, other traders will wait to sell either that close or below this bear bar, looking at this as a minor reversal and now a bear trend. The wedge channel is fairly tight. The pullbacks are small here and here. And we have a good tight bull channel here. Therefore, traders are not looking at this as a higher high major trend reversal. In other words, bull trend, break below a very tight bull channel, and then bull trend resumption. Most traders would not look at this as a higher high major trend reversal. They would look at it as a wedge, maybe, but not as a major trend reversal. Now they'll start wondering, after 6 bear bars here or 6 bars down here, traders will start wondering, are the bears getting strong enough to create a major trend reversal? In general, whenever you're taking a major trend reversal sell setup like this, there's a 40% chance you'll get a swing down, 60% chance you'll either stay sideways or the bull trend will resume up. The market's in a bear trend here. Traders assume that every reversal up is going to be minor, especially after this bear breakout when it's clearly bearish. The reversal attempt minor. This reversal attempt has pretty good buying pressure, but it's still probably minor. And then the bear trend resumed even stronger than the bulls rallied here, and therefore traders assume that this reversal attempt is minor as well. However, it's a very strong reversal attempt, and it totally reversed this strong sell-off, and therefore the odds are that either the market now is in a trading range or possibly even a bull trend. They'll look for the bear trend to resume, and a lot of them will buy a reversal up, betting that, in fact, we're forming a higher low in a new bull trend. The bear trend tried to resume. The bears have 6 bear bars, but a higher low, and this forms a slightly higher low major trend reversal, maybe above this bull bar. and it's also a double bottom higher low major trend reversal. In general, traders want to see the bear trend retrace at least a third or so of the minor reversal. If the bears are able to do that, traders will assume the bear low has been adequately tested. If it reverses up from there, they're more willing to buy, betting that a major trend reversal is underway. In general, 40% chance that a major trend reversal will actually lead to a major reversal, a reversal into an opposite trend. We have a minor reversal that's very strong enough so that we'll probably get a second leg up. You can argue there's a wedge here, 1, 2, 3, but we did get 2 small legs down, 1 pullback, 2. This is enough of a reversal so that traders expect a 40% chance of a swing up and probably a 50 or 60% chance of a test back up to these highs. Again, traders like to buy above the bull bar, especially after 5 consecutive bear bars. Most traders will not buy above the bear bar, so they'll either buy above this bull bar or above this bar and get filled here. And you can see a lot of traders bought during this bar. The successful reversal from this higher low major trend reversal means 2 legs up and a profit that is at least twice your actual risk. If you buy above the high of this bar, your actual risk turned out to be just below the low of this bar, and this is several times greater than that actual risk. Most major trend reversals result in big trading ranges. For example, we have a bull trend, a lower high major trend reversal, and at this point, we're in a trading range. Now we have a bear trend and a bull break above the trend line, and now we have a higher low major trend reversal, and at this point, it's still part of a large trading range. However, legs within a trading range can be big enough for a swing trade. Swing traders selling here or here or here made a swing profit, and swing trading bulls who bought above here or above here made a swing profit as well. We have a bear trend here. If ever you see a reversal and you're wondering if it's a major reversal, but it does not look quite right, you should expect it to be a minor reversal. And a minor reversal means a reversal into either a bear flag or into a trading range. For example, here we have a bear trend and we have an attempt to reverse, but a minor reversal. Is this enough of a reversal up for traders to expect the next reversal up to be a major reversal? No, it's not enough buying pressure. It only lasted a few bars. If you look at a smaller time frame chart, you might start looking for a major reversal. But on this chart, this is not enough buying pressure for traders to look for a major trend reversal. So the next reversal up is probably going to be minor, which means a bear flag or part of a trading range. You can buy this. It's a high 2, high 1 here, high 2 here. Wedge, 1, 2, 3. A higher low, a double bottom higher low, a decent reversal bar. However, you're buying this expecting a minor reversal. You're expecting a scalp. You're expecting the rally to not last very long and not become a swing up. You're only looking for a pullback that is either going to end up as a part of a trading range or a bear flag. We have a bull trend here, and if you're looking for a reversal and it does not look quite right, it's probably a minor reversal, a reversal into a trading range or a bull flag, and you expect the bull trend to resume. Bull trend here, minor reversals, became a bull flag, the bull trend resumed. We're trying to get a bull trend here. Is this probably going to be a major reversal down? It might be. However, we have 2 very big bull bars here and only a 2-bar pullback here. This is probably a minor reversal and probably either a bull flag or part of a trading range. Therefore, If traders are looking at this as a potential major reversal or this as a major trend reversal, they'll be disappointed. This is not enough selling pressure for traders to expect the next reversal to be major. The next reversal is probably going to be minor. You can take this trade. It's a second entry short, a micro double top, a double top bear flag, a lower high, but very good buying pressure. This reversal down is probably minor, a minor reversal in this early bull trend. If you take that trade, you're looking for a scalp, not for a swing trade. Major trend reversals, they have about a 40% chance of leading to a swing trade, which is fine because a swing trade means a profit at least twice as big as your risk, and that more than offsets the 40% low probability. A lot of times, the first reversal does not work. We have a bull trend, very strong breakout, and here we have a second entry for a lower high major trend reversal. First entry, no one's going to take that. 4 consecutive bull bars, 5 consecutive bull bars. You wait for a second entry. This is a second entry, lower high major trend reversal. And look what you got. You got a big reversal up from a higher low. Not a successful trade. A lot of traders would exit their short above here. And now we have another micro double top and a double top, and it's a second entry short for a major trend reversal. This time it's a double top, lower high. This double top is below this high, so it's a double top, lower high. You have a bear bar here. This is another short. And it did not succeed either. Most bears would get out here. We have a second entry buy here or above here, and they'd have a small profit. Here they'd have maybe a small profit or break even. Now the market's going up higher, and we have a wedge. 3 pushes up, 1, 2, and then 3. Micro double top here, nested wedge. 3 pushes up, 1, 2, 3, and it's slightly below this high. You can call the entire pattern a double top. This is slightly below that. You can say it's a lower high major trend reversal, but it is a potential major trend reversal, and traders can take this short for a swing down. 60% of the time, when you have a reasonable major trend reversal setup, you're going to get a minor reversal from the major reversal setup, and you'll have a small profit or a small loss. But 40% of the time, you'll get a reward that is at least twice as big as your risk, and often the reward will be several times bigger than your risk. And that more than makes up for a 40% chance of a swing trade profit. Of the 60% of the trades that are not swing trade profits, half of them are small losses, half of them are small gains, and they offset each other. So 60% of the time, it's basically break even. 40% of the time, you make a substantial profit if you manage the trade well. Here we have 3 different major trend reversal setups. 1 out of the 3 led to a swing trade. The other 2, break even, maybe a small profit, small profit. There are many types of reversals: wedge tops, double tops, climatic tops, bottoms. Major trend reversal is the most important reversal pattern for most traders. A major trend reversal has a strong trader's equation. The math is good. The math makes sense. Even though the trade has only a 40% chance of a successful swing trade, the strong risk-reward ratio more than makes up for the low probability. We have a bear trend and a pretty good breakout here. Is this a major trend reversal? Probably not. It's only 2 bars down. However, now we have 10 or 15 bars sideways. This is a higher probability for a swing trade. A double bottom, higher low, major trend reversal. Some traders would put their stop here. Other traders would keep their stop down here. Now we have another double bottom. And again, this double bottom is a higher low. So a double bottom, higher low, major trend reversal. 2 legs down, 1 pullback 2, 2 legs down, 1 pullback 2. A nested pattern, a very dramatic 2-bar reversal. This is a good buy setup for a potential swing trade. Traders will look for, at a minimum, 10 bars, 2 legs up. Realistically, there's a 40% chance that they'll get a swing up. A swing trade means 20 or more bars, at least 2 legs, and at least a reward twice the risk. And here, the bulls got a reward several times the risk. We have a bull trend here, a broad bull channel, a bear breakout. I don't have the line drawn, but bull trend, bear breakout, and a big higher high. So it's a higher high major trend reversal. Not a very high probability short because this channel up is so tight, but it's a reasonable short because the reversal is so dramatic. If you take this short, your stop is above this high, so you have to trade small. If you do not take that short, you can wait and then maybe look for a lower high major trend reversal and sell here. Bear trend, a bull break above the bear trend. Here's the bear trend, here's the breakout. And you can call this a triangle, 3 pushes down, 1, 2, 3, mostly a horizontal pattern with 3 pushes down, and it's converging. It's sloped slightly down maybe. You can call it a wedge if you want, a wedge bull flag. We have an early bull trend, a wedge bull flag. You can call it a double bottom, higher low major trend reversal. It doesn't matter what you call it. It's a buy setup above the high of this bull bar. You can call this a wedge top if you'd like. If you want, you can call it a bull trend, a bear breakout, higher high major trend reversal, or you can say 3 pushes up. 1, 2, these 2 legs, you can call these 2 legs 1, 1, second, and then third. Or you can say we have a wedge top, 1, 2, 3, that failed, and now we have a second top. A bull breakout above a bull channel, 75% chance you're going to get a reversal down. Again, it doesn't matter what you call it, but it's a reasonable setup for a major reversal. 2 legs down, 1 pull back 2. Head and shoulders top if you want. Left shoulder, head, right shoulder. Every head and shoulders top is a lower high major trend reversal, right? Because the right shoulder is always below the head. And if you're talking about a head and shoulders top reversal, it's got to be a major pattern. It has to be enough bars to be major. For example, this is a head and shoulders top, left shoulder, head, right shoulder, but the pattern is too small to be a major reversal. You expect only a minor reversal in a trading range or a bull flag. This is enough bars for a major reversal. And anytime you have a major head and shoulders top, you have a lower high major trend reversal. I said that a major trend reversal has a 40% chance of leading to a swing trade. The advantage is the risk is small. You're entering early before there's a confirmed reversal. The reversal only comes after a strong breakout in your direction. Here we have a double bottom, higher low major trend reversal. There's a little bit of a reversal up, but then reversal down. Big up, big down, big confusion, sideways. And now we're reversing up again, but we only pulled back a little bit. At this point, is this a strong bull trend? Of course not, but it is a good major trend reversal setup. At this point, it's probably a bull trend somewhere up in here. But at this point, it's a reversal, but not yet a strong bull trend. The probability is only about 40% if you buy here. Now we have the reversal. We have a series of consecutive big bull bars closing on their highs. Buying at this point has a much higher probability of a profit. Whenever you have high probability, your risk reward is worse. The stop for these bulls, buying either this close or that close, is down here. So the risk is greater. However, that's the price you pay when you take a high probability trade. Up here, we have a lower high major trend reversal, a small double top, a decent 2-bar reversal, a reasonable setup, but you're in a tight trading range. More likely, we're going to go mostly sideways. However, it's a reasonable setup. It is not yet a reversal. It's a reversal setup. After you see a series of bear bars, here we have 3 bear bars closing on their lows, traders begin to suspect that this is, in fact, the early stages of reversal. And then a big bear bar here, follow through bar here. So at this point, traders are probably comfortable that this is an early reversal. It never had the momentum down that this had going up, so it never had the high probability that the bulls had over here. But at some point in here, here, or here, traders conclude that a reversal is unfolding. The advantage of entering early with a major trend reversal setup, it minimizes risk. If you sell here, your stop is here. You're looking for a reward at least twice your risk, and you got that here. Same here. If you buy here, your stop is here, and you would have gotten out here or here, and you would have had a reward several times greater than your risk. You paid for the small risk, big reward with lower probability if you take the early entry. If you take the later entry, your risk reward is worse, but the probability of making money is high, 60% or higher. Higher low major trend reversal, lower high major trend reversal. Here's the reversal pattern, here's the reversal. Now we have a high probability of higher prices. Reversal setup, starting to get a bear breakout. As the bear bars get added, the probability starts to go up that you're going to get lower prices. Most traders would not conclude that this is always in short until you had at least 3 bear bars or 1 or 2 big bear bars, big bear bar, follow through bar. Most traders would not conclude this is always in long until you started to get consecutive bull trend bars, either here or here or here. Consecutive bear trend bars again. We have consecutive bear trend bars here, closing on their lows, and again here. At this point or this point, most traders would conclude the market is in control of the bears and that we're going lower. A bear trend, so you have a bear trend line, and you have a strong break above the bear trend line. We went sideways, and then we had a reasonable higher low major trend reversal. Traders want to see more than just one bar. They want to see follow-through buying. Here we have a second consecutive bull trend bar closing on its high. And now we have an even stronger bull trend bar closing on its high. The bears are giving up and bulls are taking control. The bulls are buying aggressively and they're expecting some kind of a measured move up at a minimum. The breakout convinces traders, both the bulls and the bears, that it's now a bull trend. Again, higher probability to buy after you see the strong bull breakout. You pay for that high probability with greater risk because the stop is further away. It doesn't matter if you buy here, here, or here, the stop is still down here. But buying up here, you have a higher probability of making money. A very big bull bar, you can buy this close, or you can buy the close of the follow-through bar, or the close of this follow-through bar after this big 2-bar breakout. Stop below the bottom of the bull breakout. This is a bull breakout by climax. A major higher low. Double bottom, higher low. Double bottom, here's the old low. This is a double bottom above that low, so it's a double bottom higher low. And it's a break above a bull trend line, so it's a double bottom higher low, major trend reversal, buy setup. When you have a strong bull breakout above a bear trend line, traders watch for a higher low. Sometimes you get a lower low reversal, sometimes you get a higher low reversal. Sometimes you get a perfect double bottom. In any case, traders watch for a resumption of the bear trend that fails and reverses up. And they look to buy the reversal up. Reverse up here, reverse up here. It's no longer a bear trend. It could be a trading range. It is a trading range, but it could also lead to a bull trend. The bulls buy, knowing that it might simply be a trading range, or it might be a bull trend. They're hoping that the reversal up leads to the first of many higher lows. This low is above the bear trend low, just as this low is above the bear trend low. This led to a wedge basically an expanding triangle, 1, 2, 3. And you can see a lot of the bulls gave up here. They bought again here, and this time they got a swing up and a series of higher lows. Here, 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 even here. We have a bull trend. We have a bear break below the trend line. We have another bear break below the trend line here. This is a lower high major trend reversal. I drew this trend line. I could have drawn a trend line here and said that this is the break below the trend line, and it is. This would then be a higher high major trend reversal and then a lower high major trend reversal. It's also a broad bull channel, deep pullbacks. So you could draw a trend line using that low or even this low as well. All of them are acceptable ways to show the bull trend. The bears broke below the bull trend line using this reversal up and this reversal up. Yet, look what happened. Very bad follow-through selling. Strong reversal down, bear bar, but instead of a series of consecutive bear bars, we got a very big reversal up. The traders are not convinced that this is the start of a bear trend, even though it's a higher high major trend reversal. I could draw a trend line here, a bear break below the trend line, higher high major trend reversal, but very strong bull trend resumption up. The market might instead be resuming up in a broad bull channel, or it might be a trading range. Big up, big down, big confusion. Now we have big up, big down, and big up again, big confusion, usually means trading range. But whenever there's a trading range, there's always a sell setup, and there's always a buy setup as well. Here we have a potential lower high major trend reversal. Even though we're trending down here, it's not all that strong. No big bear breakout with good follow-through. Many traders see this as a bear leg in a trading range, and it is. We're up, we're down, we're up, we're down. We're still above this low, we're still above this low. It's a bear leg in a trading range. However, it lasted about 20 bars, and that is enough for a swing trade down. Even though we do not have a bear trend, we have a bear swing. Here, we have a bear breakout and a bear follow-through bar. This is more likely to lead to some kind of a swing trade. Whenever there's a break below any bull trend line, the bears watch for a resumption of the bull trend and for a lower high. If the market goes above the old high, then they look for a reversal down from a higher high. In any case, after they get a break below a trend line, traders are watching the next resumption of the bull trend to see if it fails and creates some kind of a double top, a lower high, a perfect double top, higher high. They want a reversal down. They want the resumption to fail for the market to begin a swing down. Traders will look to sell. We have a micro double top here. We have a bigger double top here. They'll sell below this low. They'll sell below this bear bar. We have a lower high in a bear channel. They'll sell below that bar. Now we have a micro double top, this high, that high. They'll sell below that bar. At some point, traders conclude that it's no longer a bull channel. It's either a trading range or a bear trend. Somewhere in here, more and more traders are concluding the bull trend has ended. Once the market falls below a major higher low like here or here, traders would conclude the bull trend is definitely over and that the market's either in a trading range or a bear trend. And they're hoping that this lower high is the first of many lower highs, and a series of lower highs means a bear channel, which is a bear trend. We have a bear channel. We have a bull breakout, not especially strong, 3 or 4 bars up, 5 or 6 bars up. However, traders will wonder if the next reversal down will fail and lead to a reversal up, a major trend reversal. This is probably a minor reversal. I say that because this bull breakout only lasted about 4 bars, so the next reversal up probably will not get too far, and the bulls probably would need some kind of a double bottom. They'll buy here, either for a scalp or a swing. Now they have a double bottom. You can call it a lower low major trend reversal, but really not much buying pressure here or here. This is possibly simply a minor reversal. However, some traders will buy it, certainly for a scalp, possibly for a swing. I don't have it drawn in, but if I drew a trend line here, this is a strong break above a trend line, and therefore the next reversal down, if it fails, could lead to a major reversal. To me, this is more of a major trend reversal, buying above this bull bar. We have a micro double bottom after a strong bull breakout above the bull channel. Very good breakout here, maybe a minor reversal and a trading range, maybe a trading range in a bear trend. Bulls, they either buy here, or they buy here, betting on a major reversal, 40% chance. If they want higher probability, they wait until they see a strong breakout or a good follow-through bar. The bears are giving up. The bears in this bar have decided that they've lost control over the market. A very big bull bar, that's a sign of the bears panicking out and a sign of the bulls buying aggressively. The odds of follow-through buying after a strong breakout with follow-through like this, 60 or 70%, that if you buy here or here, you're going to get some kind of a measured move up. When there's a rally right here, we have a bull trend, and we have a rally up here, and we have a double top, maybe a slightly higher high major trend reversal, and it follows a weak sell-off like this, only 2 bars down. Usually this reversal is minor, and if you're looking for a swing trade, it's usually better to wait until there's a strong bear breakout and then resumption up, and then you look for that resumption up to fail. This short and this short, minor reversals. But once you have a strong bear breakout, if the market resumes up and fails again, then this is more likely to lead to a major reversal. Only 2 bars down, probably a minor reversal. So this is probably a minor reversal down. This is probably a minor reversal down. It might be major, but usually with only a 2-bar sell-off that does not even get close to the moving average, the next reversal down will be minor and lead to a trading range rather than a bear trend. If you want a swing trade, it's better to wait until you see very strong selling by the bears, and then you wait for the bull trend to resume and look for that resumption to fail. This is a lower high major trend reversal. 40% chance of a swing down. Shorting here or shorting here, probably just a scalp, because not enough selling pressure for traders to believe the bull trend will become a bear trend. After this, we have good selling pressure. That's a sign that the bears can be strong. Bears then will try to reverse the trend and get a swing down after the next resumption up. A bull trend, it's a wedge, 1, 2, 3. And we have a pretty good reversal down here. This is probably good enough for a major trend reversal, although it ended up being a high 2 bull flag, 2 legs down, 1 pullback 2. However, it broke strongly below the bear trend, and traders therefore will look for the next leg up to fail around the old high. And we have a slightly higher high major trend reversal. You can call it an expanding triangle. 3 pushes up here, higher high, and we have a lower low here. But to me, I would just call it a major trend reversal. You can also call it a consecutive top. We have a head and shoulders top, left shoulder, head, right shoulder, and it failed. And now we're trying to top again with a higher high major trend reversal. A reasonable sell, micro double top here, consecutive tops. We have a head and shoulders top here, and now we're topping out again. Higher high major trend reversal after good selling pressure. The bears were strong here. Maybe with a new high, they'll be strong again and they'll be able to create a swing down. You can sell here, you can sell here. Now you have a strong bear breakout. Traders believe the bears are taking control, and a pullback, a reversal attempt probably will fail. Traders will sell below that bear bar, expecting a swing down. This is a small double top, lower high. Even though this high is below that high, I still look at it as a small double top bear flag after a strong bear breakout. I mentioned that we have a wedge, 1, 2, 3, led to 2 legs down. The bull trend resumed, And now we have a potential expanding triangle top, and every expanding triangle top is a higher high major trend reversal. That's a reasonable sell. Lower high major trend reversal, but we got a trading range instead of a bear trend. I call this a lower low major trend reversal, a bear trend bull breakout, lower low major reversal. I think it's probably more a minor reversal because there's not much buying pressure here. But more likely this is going to lead to a trading range instead of a bull trend. Here you have a double bottom, higher probability of a bull trend, but it's still probably minor. Once you get this, a series of bull bars, and then a resumption of the bear trend, you have a better chance of getting a major reversal. A lot of bears did not exit here. They assumed the bull reversal would be minor and lead to lower prices. A lot of bears did not exit here. Again, they were assuming it's a minor reversal that would lead either to a trading range or a bear flag. However, then they saw this and they changed their minds. Now they were trying to get the bear trend to resume. They failed. They failed again and they gave up here. Once you get a breakout like this, the bears are hoping for any kind of a pullback so they can buy back their shorts with a smaller loss. Strong breakout. The bears are hoping for a deep pullback so they can buy back their shorts with a smaller loss. And the bulls, once they see this, they believe the market's going higher. They're hoping for any kind of a pullback so they can buy and get long. They're expecting a second leg up. And then once the market starts to go up like this, it's clear the market's going higher. The bears are trapped and they have to buy back their shorts. After this strong break above the bear channel, both the bulls and bears expected a second leg up. The bears used the pullback to buy back their shorts. The bulls used their pullback to buy as well. With both bulls and bears buying, the odds are high you're going to get at least a small second leg. Here we get a very big second leg. Bulls who wanted higher probability, they wait until they see a very strong bull breakout and they buy the close here or buy the close here. Again, if you're buying after the strong breakout, your stop is down here, your risk is greater, and that's what you have to pay if you want a high probability trade. I began by talking about the difference between a major reversal, looking for an opposite swing or trend, and a minor reversal, looking for a trading range or a bear flag or a bull flag. A major trend reversal is the most important type of reversal pattern because it is a reversal from one trend into an opposite trend, or at least into an opposite swing. And traders have the potential to make a swing profit, a big profit. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 4 videos on major trend reversals. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 4 videos on major trend reversals. I'll be talking about what constitutes a successful lower high major trend reversal. Here we have the end of a bull trend. I don't show the bars to the left. It was starting to sell off. We tried to rally here. Not enough bars for a major reversal, probably a minor reversal, and possibly a bull flag on a higher time frame chart. Although you don't see the bars to the left, there's a bull trend. And then we start to reverse down for 20, 30 bars, and then the bull trend resumes. This is a test of the old bull trend high, and it failed. It stopped at the prior minor lower high. We have a double top, and this high is below that high, so it's a double top lower high major trend reversal. Traders will sell this, or they'll sell below this small double top here, or the second entry short below this little bear bar here, taking a chance that the market will have a swing down. In this particular case, you could also call it a triangle. 3 pushes up, 1, 2, 3. Even at this point, it's still potentially a bull trend. We might get bull trend resumption. So bull trend trading range, once the trading range lasts 20 or 30 bars, there's both a bull setup and a bear setup. 50% chance you'll get trend resumption up, 50% chance you'll get a trend reversal down. It wasn't until here that traders concluded the bull trend had ended and the bear trend began. 2 or more bear bars closing near their lows. The market now is clearly always in short, and the odds are we're going lower. Now the market's forming lower highs and lower lows. It's in a bear trend. Bears will sell rallies. Every time the bulls try to do something strong, the bears will sell, betting that the reversals will fail. They'll sell, they'll sell, they'll sell. Double top bear flag, low 2 short, low 1, low 2. Small double top bear flag here. They'll sell below that bull bar or better, below that bear bar. A 1 bar pullback after a surprisingly big breakout, traders will sell the low 1 short below that bar and get filled here, or they'll sell below the bear bar and get filled here. Low 2 short, 1 leg up, tried to reverse down, low 1. A second leg up, a second reversal down, a low 2. And now we even have a third, a low 3 or a wedge. Traders will sell below the bear bar, betting on trend resumption and betting against a trend reversal. Traders will enter with a stop right below the low of the prior bar for all of these. They see this bar, potential sell signal bar. They'll place a stop to go short just below its low, and they'll get short on this bar, the entry bar. Again, we had a bull trend and then a sell-off. The rally lasted only about 4 bars from this low. Can this be a major trend reversal? Not likely. Major means big, and a pattern that only has 4 bars in one of the legs is not major, it's minor. It either leads to a trading range or, in this case, since we're in a bull trend, a bigger bull flag. This is a 60-minute chart of the euro versus the dollar, and we have a bull trend. We have a trading range, a double bottom bull flag, and then a bull breakout, and then we reverse down. This is a potential higher high major trend reversal. We have a high, and we have a higher high. The sell-off lasted 7 or 8 bars and went sideways for 20 bars. That's enough bars for a major reversal. And then we had a strong breakout that immediately failed. The market turned down fairly strongly. When you have a higher high major trend reversal, you're expecting at least a couple legs down. 1 pullback 2. Here we got many legs down. And therefore, after the first leg, you get trend resumption back up. You expect it to fail and form a lower high major trend reversal that leads to at least 1 more leg down. We have a big bear reversal bar reversing this. This might be a bear bar here, so this could be the second, third, fourth bear bar. At some point, traders are going to conclude that this is going to be a major reversal and not just a minor reversal into a trading range, and that took place here. A big bear bar closing below the lows of the past 20 or 30 bars, and also the 6th consecutive bear bar. And the context is good. A potential higher high major trend reversal, a wedge, 1, 2, 3. Traders believe at this point that the market is going lower, at least for 1 more leg. This is a give-up bar. The bulls are giving up, and the market's now always in short, a bear trend. Another even bigger give-up bar. We fell below the bottom of the most recent bull rally, very strong leg up. The bulls are hoping that, as long as it stays above this low, maybe the pullback will result in a trading range and then a resumption of the bull trend. Once it fell below the bottom of this very strong bull breakout, most traders gave up. And here you can see a very big bear bar closing below that low and closing below the lows of the past 50, 60, 70 bars. The bulls are giving up. Strong enough bar, big enough surprise, at least 1 more leg down. So pullback and at least 1 more leg down. We have a couple lows, 3 lows here. You can create a channel line and then create a parallel, drag it up to this high, and you have the earliest way to draw a channel. And you watch what happens when the market gets up to that line, and it's failing. Turning down strongly here, so now we're probably in a bear channel, a series of lower highs and lower lows. The bears will bet that every one of these reversals up will fail and become bear flags. Even one like this with a lot of bars in it. Where are the consecutive big bull trend bars? Where are bull bars big like this and like this? The bulls are not doing enough yet to reverse the bear trend. All of these reversals are probably minor and become bear flags. Every time there's a rally, traders assume it'll be a minor reversal. Traders will look to sell right below the low of the prior bar. We have a bear bar, traders will sell 1 pip below its low. We have a low 1 short, they'll sell below that bar. And here we have even a better looking bear bar. And it's a second attempt by the bulls to reverse the trend. So the second time the bulls are reversing the trend and failing, bulls give up. That's one of the reasons why low twos and bear trends are so reliable, high probability trades. The bulls twice tried to reverse, they failed twice, they give up. Here we have a micro double top and a double top with this high, slightly higher double top, but it's still a double top. Traders will sell below the low of that bar or below the low of this bar and get filled here. Again, the bull's trying to reverse up, but 3 inside bars. Traders will bet the bull reversal will fail and they'll look to sell below the low of the prior bar and they'll get filled here. The bulls broke to the upside, but not enough bulls buying, too many bears selling above the the market reversed down. Sideways, a small double top bear flag. Traders will sell below the low of the prior bar. Below the low of the prior bar, they'll sell. Small double top bear flag near the top of the channel. And the same right here. A small double top, not quite to the channel, but traders will sell every reversal down. They'll sell below this bar, below that bar, below this bar, and they get filled as this bar fell below that small bar's low. When you have a major trend reversal setup, there's a 40% chance of a swing profit, 40% chance of a move that's big enough for a swing profit. However, once there's a big breakout like this, there's a 60% chance that you'll make some kind of a profit, usually based upon a measured move. For example, the open of the first bar of the breakout, the close of the final bar of the breakout, and a measured move down. The probability is higher shorting after you see the breakout. Here, the probability of a swing down is lower, but the risk is less. You sell below this bar, below that bar, stop above here, stop above here. You're not risking much. However, the reward is huge compared to the risk, and you can make money even if you win only 40% of the time. After the breakout, you sell this close, for example, you sell below here, your stop is up here or here. The risk is greater. However, the probability of making money is higher, and that high probability more than offsets the risk. Selling before there's an obvious breakout and before the market is clearly always in short, lower probability of a swing profit, yet small risk. Most major trend reversals have only a 40% probability of a swing trade because you're entering before there's a strong breakout and the market clearly has reversed. Entering after the breakout, selling closes, selling below bars, selling below bars. The market clearly is now bearish. The odds are high there'll be at least a small second leg down. Here there's a big second leg down. Higher probability of profit. Measured move down, maybe from the top of the trend. We got a little bit of overlap. This bar pulled back a little bit above that breakout point. It's a negative gap. Still, you have to be thinking about a potential measured move. And we fell for more than a measured move. You could have used this high for the measured move. So this high to this gap, and it would have been here. You can see some bears took profits there, or you could use the entire top of the bear trend. If it falls below the first target, you have to look at other targets. It fell below the second target as well, using the top of the bull trend and the gap. If you take this short, a double top bear flag, breakout test of this breakout point, very strong bear breakout, This is testing the breakout point, and the trend is resuming. If you take this short, stop probably up here, because there might be one more leg up before there is a resumption of the trend down. The euro versus the dollar, we have a bull trend. Sideways for 20 bars, that's enough selling pressure so that the next rally up might be the final rally. It might be a higher high, and it might lead to a major reversal. Traders who take the early sell before there's a strong bear breakout have very little risk. They sell below the low of this bar. They get filled here. Their stop is here. Before the trend is clearly bearish, you might only have a 40% chance of a swing profit. 2 legs down, a reward at least twice as big as the risk. However, your risk is small. If you get a swing profit 40% of the time, it's a profitable strategy to take shorts like that. Most major trend reversals have only a 40% chance of a swing trade. The other 60%, small wins, small losses that offset one another. What you're looking for when you're taking a major trend reversal trade is the 40% of the time when you get a big move, more than double the risk that you take when you take the short. That huge reward relative to the risk greatly offsets the low probability, the 40% probability. If you want a higher probability trade, you wait until there's a clear bear breakout. Here we have a second leg down, a very big bear breakout, closing below the bottom of the most recent very strong bull leg. This is a major higher low, and we're closing below that major higher low. This is probably going to be a measuring gap, leading to some kind of a measured move down. Higher probability shorting here, or here, or here. If you short here, your stop is up here. Your risk is greater, but your probability is greater as well. You're taking a high probability trade, usually comes with worse risk reward. Here you're taking a low probability trade, usually comes with very good risk reward. Small risk, big reward. It's acceptable to take either trade. The initial one with the low risk and low probability, or the later ones here, or here, or here, or here, or here. Much higher probability of a profit, but the stop is usually further away. If you sell down here, your stop is above the most recent major lower high. It's a major lower high because it had a strong bear breakout to a new significant low. Minimum initial target when you have a strong breakout like that, the open of the first bar of the breakout to the close of the final bar of the breakout. Here it's a 1-bar breakout. That would be the initial minimum target, and you can see there was some profit taking there. We have a breakout below this low and a pullback. It could not go above that low, so maybe this is a measuring gap, which means you look at the start of the move and then the middle of the gap, or simply just this low, and project down for a measured move, and there probably will be profit taking there. And it's a reasonable place to take partial profits if your profits are twice your actual risk. If you sold here, your actual risk was only to like right here. It's tiny, so 2 times risk is here. That is too small a reward for a pattern this big. So I would not exit at 2 times actual risk. I would look for other targets like here. And you can see that a lot of traders started taking profits here. You can see the market starting to go sideways around these measured move targets. Traders are taking profits. The bulls could not reverse the market, so the bears sold again. If you take any of these shorts, selling that close, selling below this bar, selling the low 2 short below this bar, micro double top, breakout test, testing this breakout point. Take any of these shorts, your stop is above the most recent major lower high. A breakout to a new low, strong breakout, it's a major lower high. A major trend reversal, it's probably the best setup for beginners, and it's also a great setup for experts as well. Time is on your side. You usually can anticipate the reversal before it takes place, and it gives you time to decide whether or not to take the trade. We have a bull trend, and the market's going sideways for a lot of bars. Maybe this could be the final bull flag. Also, it's the third push up. 1, 2, 3. So it's also a wedge top in addition to a final flag top. Traders will anticipate that and they'll look to sell a reversal down. Here, a lower high after a very strong breakout, odds are we're going lower. When you see this bear breakout, traders are looking for a rally, expecting it to be a failed reversal, become a bear flag, and they're looking to sell below the low of the prior bar, especially selling below the low of a bear bar, getting filled here, getting filled here, or getting filled here. The management is usually easier than for other trades as well. It's a swing trade, so you're making fewer decisions. You simply rely on your stop. If you sell here, your stop is above the most recent major lower high. And you just stay in the trade until the trade clearly reverses, or until the end of the session, or until your reward is at least 2 times your risk, or you're down at some kind of a measured move target. Then you take partial profits. Excellent trader's equation, because the reward potential is at least twice as big as your risk, and these setups are frequent. Usually there's at least one a day if you're day trading. This is a 60-minute chart, and this is toward the end of a session during that day, so it's reasonable to take profits here, trying to reverse up. Also, your reward at this point is 5 times your initial risk. 3, 4, 5 times your initial risk, 10 or 20 times your actual risk. If you sold that close, your actual risk was just 1 pip above this bar, and this reward is 5 or 10 times bigger than that risk, which is fantastic. At some point, you have to look to take partial profits. This is a 60-minute chart. The market has had consecutive sell climaxes. We're at the bottom of a channel. I do not have the channel line drawn in, but you have a bull reversal bar. This is a logical location to take profits. If this was a 5-minute chart and this was the end of the session, exiting above that bull bar would make sense. I said that major trend reversals have a 40% chance of success. That means that 60% of the time they don't work. However, a lot of times you'll get multiple setups. Bull trend, bear break, here's the bull trend line, bear break below the bull trend. Traders will look to sell a reversal. 5 consecutive bull bars, not a good candidate for a major trend reversal, but now we have a bear inside bar, a second entry short. This would be a higher probability short. It didn't work. We kept going up. However, now we still have a lower high. This time it's a double top lower high compared to the top of the bull trend. And we tried to break to the upside and we're reversing down. So a micro double top and a double top. Traders will sell below that bear bar. That's another attempt at selling a major trend reversal. And we kept going up again. This short failed. The bears who took that short probably would get out here. You can see we raced up here. A lot of the bears gave up here around their original entry price. Maybe they had a break-even stop. Yet we have a reversal attempt and a second reversal attempt, a wedge, 1, 2, 3, and a bigger wedge, 1, 2, 3. And this high is slightly below this high, still reversing down again. It's another attempt at a lower high major trend reversal. This one led to a good swing trade. First leg and maybe second leg. Maybe second leg get out here. Maybe you keep holding. The probability of a swing trade, even with a good setup, only about 40%. 60% of the time you get small losers or small winners, and they offset one another. But 40% of the time you get a reward more than twice your actual risk. Here, the reward is many times bigger than the actual risk. If you sell below the low of this bar, you get filled here, your stop is here. Very small initial risk. Your actual risk here, if you sold below this bar, is very little, and the profit was many, many times greater than the actual risk. Very good math. If you take this short, you might get out above this big bull bar, a reversal, and a higher low. If you took this short, you might get out here. Maybe we're in a trading range, and it's a second reversal up. If you don't get out here, you get out here above this bar. Or you can see a lot of bears gave up here, and they get out around break even. If a trader exited, let's say a trader exited above this high, we have a bear breakout, so this is a major lower high. We broke above it, but it's still a possible double top bear flag, and then we have a very good bear bar. A lot of the bears would sell again below that bar, and they'll sell again here as well. We have a double top trying to reverse down. We're pulling back from the breakout below the double top. Here's the breakout below this double top, and this is a pullback short below that bear bar, and they'll sell here. If you're in a swing trade and you get out for any reason, but the premise appears to be still valid, look to sell again here or here. It's sometimes difficult to stay in a trade. For example, here we're breaking above a major lower high, but this little breakout without follow-through is not enough to convince traders that the bear trend has ended and a bull trend has begun. The bear trend ended, and now we're in a trading range, but we're reversing down from the top of a potential trading range, and this might get trend resumption from the initial leg down. Lower high, major trend reversal, bull trend, very strong breakout. The bull trend tried to resume, but it's failing at a lower high, so it's a lower high, major trend reversal, and a second entry short. First here, and then here. If you sell below this bar, maybe you put your stop above this bear bar, maybe above here. That's your initial risk, just above this bar. 1 times initial risk, 2 times initial risk. A lot of traders like to exit half of their position at 2 times initial risk. So a lot of the bears who sold here would take partial profits here, and look what happened. The market reversed up. That tells you that a lot of traders were looking to take partial profits at 2 times the initial risk. A lot of traders will take entire profits until the trend is clearly bearish, because of the possibility that instead of a reversal into a bear trend, it might simply be a reversal into a bear leg in a trading range. So it's reasonable to exit everything right here. If a trader only took half off here and they see this very strong reversal up, a lot of traders will exit above. They're concerned that this is a bull trend, a wedge bull flag, 1 push down, 2 pushes down, 3 pushes down, a breakout of the bull flag, and this is maybe simply a pullback from that breakout. So many traders would exit here, and you can see a lot of the bears gave up. That caused this big bull bar. You can either sell here or sell here, a reasonable short, a nested wedge. Again, if you exited above this major lower high, you can sell again here, and then you can sell again here. If there's a new signal, just sell again. End of the session, take profits. I talked about the components of a successful major trend reversal. For example, a lower high major trend reversal, you have a bull trend, you have a break below the bull trend line, a minor reversal into a bull flag. The bull trend tries to resume, but then it fails just below the high of the bull trend, and you get a lower high reversal. If it reversed down above the high, it would be a higher high major trend reversal. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 4 videos on major trend reversals. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 4 videos on major trend reversals. I'll begin by talking about moving average gap bars, where there's a gap between the bar and the moving average. If you have a bear trend and you see a moving average gap bar, a bar above the moving average, it usually leads to the final leg of the bear trend. And finally, most tops are double tops. There's a top and then a reversal, and then the bull trend tries to resume, and if that second rally fails, you get the reversal. Most tops require some kind of a test of the prior high before the market will enter an opposite trend. Here we have a bull trend. But then look at what took place here. We have a bear breakout below the bull trend line. And look at the high of this bar and look at the moving average. The high of the bar is below the moving average. The bears were so strong that they were able to put a bar completely below the moving average. That is an early sign that the bears might be able to take control. There's a gap between the high of the bar and the moving average. This is a moving average gap bar. You can see the gap, the space between the bar and the moving average. It's a warning that the bears are getting strong. They're strong enough now not only to get a close below the moving average, but an entire bar below the moving average. The rally after a gap bar is usually the final leg of the bull trend, and then the market either enters a trading range or you get a reversal. In this case, we got a small double top, lower high major trend reversal. So it's a short below that bar or below this bar. Traders know it's still a bull trend. However, they know that whatever rally that follows this probably will be followed by a major trend reversal attempt. Here it's a lower high. It could have been a higher high, but in any case, once you see a bar completely below the moving average, you know the bears are getting strong, and you're probably transitioning from a bull trend into either a trading range or a bear trend. Because of the strength of the bears and the loss of strength on the part of the bulls, traders expect a trading range or a bear trend. In either case, they want to sell high. They'll look for reversals up to fail and either lead to a trading range or a bear trend. They'll sell rallies. A major trend reversal, you need two things. You need context. The bars to the left have to give you a reasonable chance of a reversal, and you want a good signal bar. If you're selling in a bull trend, you want a good sell signal bar to increase the chances of a profitable trade. Here we have a bull trend, a bear breakout. The bears are strong, and we have gap bars, a series of bars with highs below the moving average. The bears are strong enough now to put bars completely below the moving average. Probably whatever bull trend resumption we get after these gap bars will lead to the final leg of the bull trend, and the bull trend will either transition into a trading range or reverse into a bear trend. When you get the break below the bull trend line, at a minimum, you'd like to see a series of bear bars, 5 or 10 bear bars. You prefer the reversal down to hit the moving average, but it's not always the case. You expect the bull trend to resume. It resumed here. It resumed again here. However, you're expecting it to fail around the prior high. Here we had a lower high major trend reversal. Left shoulder, head, right shoulder, head and shoulders top. And we got 2 legs down from the wedge. So wedge top, 2 legs down. And the bull trend resumed after a series of gap bars. Gap bars usually lead to a major trend reversal. We had a lower high major trend reversal attempt here. We have gap bars, so the next rally probably will lead to another attempt. So we have a head and shoulders top and a wedge top, head and shoulders top. That failed. And these bars tell us that whatever rally we get from here will probably fail again. So now we have consecutive tops. We tried to top out here. We have a new high, probably going to try to top out here because we had bears strong enough to put bars completely below the moving average gap bars. When traders see this rally, they're going to look to short. Will they short below this bull bar? No, it's a surprise. It's breaking above the right shoulder of a head and shoulders top. There probably will be at least 2 legs up, 1 pullback 2. However, after that second leg up, traders will look to short, especially if there's a decent sell signal bar like this, a bear bar closing on its low. We have a bull trend, a test of the moving average, 6 consecutive bear bars, a sign of strength on the part of the bears. Bears will look to sell. Head and shoulders top, lower high major trend reversal, reasonable to sell here or here, but the sell failed. And now we have a consecutive top. We tried to top out here, a wedge, tried to top out here, lower high major trend reversal, and now we're trying to top again. Traders will sell the lower high major trend reversal, And now we have a high 2 bull flag, leg 1, pullback, leg 2. After a wedge top, we're probably going to try to get trend resumption. And we have moving average gap bars. Usually the first time you get bars below the moving average in a bull trend, the bull trend will resume. So traders will look to buy a reversal up from these gap bars. The bears who sold here will get out here, and bulls will look to buy as well, expecting at least one more leg up. You can redraw the trend line. This low, that low. We broke below the new trend line. Traders will look to sell a reversal down after testing the prior high. Here the test is slightly above, so it's a higher high major trend reversal, and it has a decent sell signal bar. Context, the bars to the left support a likely reversal and signal bar. Most tops are variations of a double top. You have a top, the bears try to reverse. The first reversal usually is minor, and then the bull trend resumes. If it reverses down a second time, that has a higher probability of leading to an opposite trend, a major reversal. We have a bull trend, and then we have a reversal down. This is testing this. So this is a double top with this. It's slightly below. We have a new high, a higher high. This is reversing down again. It's a double top with this. So it's testing the trend high. So a higher high major trend reversal is a type of double top where the second high is higher. A lower high major trend reversal is a double top where the second high is lower. Sometimes you get perfect double tops, but they're rare. This could have been close to a perfect double top. This was slightly above that. Perfect double tops are rare because to get it to exactly the same price is unusual. Normally, it's a little bit above, higher high, or a little bit below, lower high. A lower high major trend reversal, a type of double top. Higher high major trend reversal, a type of double top. This is also a breakout above a head and shoulders top. Left shoulder, head, right shoulder. It tried to get the bear breakout. It broke below the neckline, but reversed up strongly. 2 legs up. After the second leg up, traders will look to sell. The principle is the same. We have a bull trend that tried to reverse down. The bull trend resumed up, testing the prior high, and traders will look for a reversal down again. The first reversal down, usually a minor reversal, and leads to a trading range. But the second reversal, there's a reasonable chance of getting a major reversal. Here, 40% chance of a bear trend or a bear swing. It did not become a bear trend. The bull trend resumed. Again, 40% chance of a bear trend or a bear swing, and this time it succeeded. Major trend reversal bottoms, they're all simply variations of double bottoms. We have a bear trend. We have a breakout. We tested the bear trend low and reversed up from a higher low. You can call this a bear trend, and this a breakout below, possibly a final flag, and a reversal up. This is a double bottom with this. We tried to reverse up, failed, and we're trying to reverse up a second time. So this is a test of that low, and it's a double bottom, slightly lower low. The bulls tried for a reversal and failed. The bear trend resumed, but the resumption did not last long. It simply tested the old low, and then we have another reversal attempt, even stronger. This is a slightly higher low, but it's a double bottom. Lower low, major trend reversal. Higher low, major trend reversal. This is a double bottom with that. We have a new low in the bear trend. This is a test of this. It's a double bottom with this, slightly higher low. As well as this. This is another attempt by the bears to resume the bear trend. You could call it a double bottom with this low or with this low. And there's another bigger higher low major trend reversal. So bear trend, very strong bull breakout. The bears tried to reverse, but could not get down to the old bear low. It's a big double bottom, a higher low double bottom, but it's still a double bottom. This higher low major trend reversal is a higher probability buy because this breakout is so strong. Chances are the market will either be in a trading range and no longer in a bear trend, or it will be the start of a bull trend. And you're starting to get bull bars here. Probability that this bear breakout will fail is good. The market did not fall below the bottom of this very strong bull breakout. This bear breakout is failing, and it's failing again. Bulls will buy, betting that this bear breakout is a bear trap, trapping traders into selling. And we got a higher low above this low, higher low above that low, higher low above this low, and a reasonable buy for a high probability buy for a swing up. The principle is the same with this, with this, with this. These are all major trend reversals. The market is testing the low of the bear trend and deciding whether it'll break to a new low or reverse up. We tested the low, reverse up. Tested the low, reverse up. Tested the low, reversed up. Here we have a bull trend and a bear break below the bull channel. You can call this a double top. It's actually slightly higher than that. It doesn't matter what you call it. It's a major trend reversal attempt. Double tops are rarely perfect. They're usually at least a little bit above, a little bit below, sometimes a lot below, sometimes a lot above. But this is a double top or a higher high major trend reversal. Bull trend here, first reversal down, probably minor. Continued bull trend here, first reversal down, probably minor, bull flag or a trading range. Traders will look for the bull trend to resume, but they'll be ready for the resumption to fail around the prior high, and they'll look to sell a reversal down because it would then be a major trend reversal. 40% chance you'll get a swing trade. Again, it doesn't matter if you call it a higher high or a double top. It's an attempt by the bulls to resume the trend, and it's failing again around the prior high. So it's a double top, it's a sell. We have a bull trend. The market went sideways for a lot of bars. And here we even broke below the moving average, and we have a moving average gap bar. A gap between the high of the bar and the moving average. The sign of strong bears. The pullback here did not quite reach the moving average, even though we pulled back from the bull trend for 11 bars. 11 bars in a tight trading range. The market's neutral, but traders expect that the bull trend will resume, which it did. We got a double top, major trend reversal. I don't know if it's perfect. I don't know if it's a little bit above, a little bit below. Let's call it a double top, a reasonable sell. However, you have to be suspicious. Not much selling pressure, only 2 decent bear bars and a tight trading range, did not even pull back to the moving average. This is a lower probability short, probably less than 40% chance of a major reversal. Ultimately, it led to a major reversal, but we had this very strong attempt at bull trend resumption before we got the trend reversal down. Most bears that took this short probably would get out above this bar, a moving average gap bar and a bull trend. They expect a test of the bull trend high. However, they'll be ready to short again. A small double top, tried to resume up a second time. Traders will look to sell below the low of the prior bar. If the bull trend fails twice trying to go up, maybe it'll go in the other direction, especially since the context supports a reversal. We've broken below the bull trend line, and now we have a gap bar, a bar completely below the moving average, a sign the bears are getting strong. Not a very strong sell signal bar, just a doji. Not a very strong sell signal bar here, a bull bar. Some bears would sell below the low of that bull bar because of the double top. Others will sell below a bear bar, like maybe below this neckline of this double top. And you can see a lot of traders sold. It looks like a lot of them sold with the stop below this bear bar. These are not high probability shorts, maybe about 40%. However, once you see this, we have a series of bear bars. Again, I could draw a trend line here, and this is a break below the trend line. It's also a break below here. It's also the entry for a reasonable lower high major trend reversal. Once you see 3 bear bars closing on their lows, this bar closing below this low, and closing below the low of the past 30 bars or so, the market's clearly always in short. The odds are there will be at least a small second leg down. Here there was a big second leg down. Higher probability to sell after you see the big breakout. Whenever you take a higher probability sell, the stop is usually further away. A higher probability sell is usually a breakout, and that means the stop is going to be far. That's the trade-off. You can take the lower probability short with low risk, or you can wait for the breakout and the market to become clearly bearish and then sell. You have a much higher chance of success, but the stop is further away. The same with selling down here. You could sell any of these closes. High probability, we're going at least a little bit lower, but the trade-off for high probability shorts, the stop is further away. Worse risk reward. A pullback from this very strong bear breakout. A good sell signal bar. This is a good short. Stop either above this high or above here. Double top major trend reversal. Lower high major trend reversal. For a reversal, you need signs that the bears are strong. Traders have to believe that the bears are strong enough to take control over the market and create a swing down. We got a pullback to near the moving average. That is a sign of strength. The bears could control the market for about 8 or 10 bars here. That's good, but not much selling pressure. A break below a bull trend line, that's a sign of strong bears. A bull trend line, a break below the bull trend line, another sign of strong bears. Here we also broke below the moving average. We closed below the moving average here, here, and here. 3 closes below the moving average. Also signs of strong bears. If the selling pressure is not particularly good, the reversal down probably will be minor. Even this does not have much selling pressure, and we got a strong breakout, but the reversal was minor. The bull trend resumed, and we got a trading range. However, 2 big bear bars, 3 closes below the moving average, and now a moving average gap bar. The bears are getting strong. Higher probability that the reversal up will fail, and the bears will get a major trend reversal down. By higher probability, it's still only 40% until you get that or that. At this point, it's 60% that we're going at least a little lower, and selling any of these closes, 60% chance you make money if you manage the trade correctly. All charts have 2 variables. There's a horizontal axis and a vertical axis. Usually the horizontal axis is time and the vertical axis is price. Bears can show strength by moving price quickly in their direction, but they can also show strength just by time, owning a lot of bars, preventing the bull trend from resuming up for a lot of bars. And that is often sufficient for a major reversal, a sufficient sign of strength on the part of the bears. Tight trading range, 10 or more bars. Even though the bars are weak, it's still enough evidence that the bears can stop the bull trend, at least for a lot of bars. And sometimes that can lead to a major reversal. They can show strength based on price, moving the price down quickly here and here. Bears are strong based on time, owning a lot of bars, stopping the bull trend for a lot of bars, or based on price, a quick move down, big bear trend bars. In a bull trend, you should always be drawing bull trend lines before there's a sell-off. We broke below the line. A very tight bull channel, any reversal is probably minor, which means probably leading to a bull flag, and then the bull trend will resume. As soon as you get another reversal up, you can keep drawing lines. We have two reversals up here, you can draw a line. We have a reversal up here, you could draw a line this low and that low, and we get a bear break below it. The trend line serves as a reminder that if there's a break below the line and then the bull trend resumes, you might get a major trend reversal. If the bears are strong enough to break below a line, they might be strong enough to create a reversal. Ideally, you want a very big breakout far below the line. That is a sign of very strong bears, and it increases the chances that if the bull trend resumes, the resumption will fail and you'll get a reversal down. The bull trend resumed, but it began to reverse down, and then it reversed down strongly after a test of the prior bull high. At this point, the reversal has become a major reversal. We're probably in a bear trend. We're clearly in a bear trend. Double top major trend reversal. You can take that short, not yet high probability. While the bears own the market for about 8 or 10 bars, not much in terms of big bear bars. They're controlling the market in terms of time, but not in terms of price. Whenever there's a double top or a higher high major trend reversal, and then you get a bear breakout, it's usually followed by a lower high major trend reversal and a second leg down. Here's a second leg down. It's strong enough so that it will also probably have at least one more leg down. And that lower high is another opportunity to sell. I talked about moving average gap bars. For example, if you're in a bull trend and the bears get a reversal down and they put a bar completely below the moving average, the high of the bar is below the moving average. There's a gap between the high of the bar and the moving average. That's a sign of strong bears. It usually leads to the final leg of the bull trend before the bears attempt a major trend reversal. Finally, I talked about how most tops are double tops. It doesn't matter if it's a higher high or a lower high, it's a variation of a double top. Most bottoms are double bottoms. Most major reversal bottoms are double bottoms. It can be a perfect double bottom, rare, or it could be a higher low, it could be a lower low, but most major trend reversals at the low come from some kind of a double bottom. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 4 videos on major trend reversals. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 4th of 4 videos on major trend reversals. I'm going to begin with major trend reversal bottoms. Next, I'll move on to head and shoulder reversals, tops and bottoms. And finally, major trend reversals often fail, and I'll talk about failed reversals. Here we have a bull trend and then a pretty good bear trend. If I were to draw a trend line, it would be here. The first thing I need to see is a break above the trend line. I prefer the break to be relatively strong. For example, 5 to 10 bars reach the moving average, and even better if there's a gap bar, the low of the bar above the moving average. That means the bulls were strong enough to put a bar completely above the moving average, and that is a sign of strong bulls. Usually the next leg down is the end of the trend, and the market tries to create a major trend reversal. A rally above the bear trend. That makes traders think that maybe the bear trend is ending, maybe it's becoming a trading range, or a bull trend. Next, you want the pullback to reach the moving average. You want the rally to have signs of buying pressure. For example, big bull bars. You want it to reach the moving average. You want it to get far above the trend line. You prefer the pullback to be 10 bars or so. Sometimes it's fewer, sometimes it's more. You do not need consecutive big bull trend bars closing on their highs, but it's better if you have them. Here we have one big bull trend bar, bad follow through, and then another big bull trend bar, but close above the moving average. Here we have a rally with very good buying pressure. We have a bear trend. The trend line does not have to be perfect. Here's an approximate trend line. We have a breakout, 3 consecutive bull bars, 1 closing on its high, 2 closing near their highs. Very good buying pressure. Even though it's only 3 bars and not 10 bars, the buying pressure is very good, and that is often enough to make traders wonder if the bear trend resumes. Will the bear trend resumption fail? Will it simply be a test of the old low, and then the market reverses up a second time? It reversed up here. The first reversal up is minor, usually leads to a trading range. However, that second reversal up often can lead to a swing trade. The break above the bear channel, better if it's 10 bars, or if you have 2 or 3 or 4 very strong bull bars, that's all you need as proof that the bulls are strong enough to take control. The bears tried to reverse down again, and they failed again. Look at this bar. The low of the bar is above the moving average. That is a gap bar. That means the bulls were strong enough to put a bar completely above the moving average. That is a sign of strength, and it usually leads to the final leg of the bear trend before an attempt at a major trend reversal. So when you see that, especially after a very strong rally, you should watch the next sell-off and look for a reversal up. If it comes from a higher low, it's a higher low major trend reversal. If it comes from exactly at the prior low, a double bottom major trend reversal. If it comes from a lower low major trend reversal. Moving average gap bar often leads to the final leg of the bear trend. Look for a reversal up after the bear trend resumes. Bear trend resumes, look for a reversal up, a second entry buy. You don't want to be buying above a weak bull doji after 2 big bear bars, not likely to reverse it, probably a minor reversal. But when you have a second entry buy and a higher low, double bottom with the bottom of the bull breakout, this low, double bottom with that low, that is a reasonable buy for a higher low major trend reversal. You buy with a stop just above the high of this buy signal bar, and you get filled on this bar. Bear trend, I can draw a trend line. We have a reversal down, reversal down. I can draw a trend line. We broke above the trend line. I could draw a tighter trend line here and call this the break. Doesn't matter. Here, the rally is about 6 or 7 bars, and we have a gap bar. When you see that gap bar, traders will watch the next sell-off. Will the market reverse around the prior low? Moving average gap bar, the market usually evolves into a trading range or into an opposite trend. You can call this a lower low major trend reversal. Not really ideal. When the channel is this tight, very little buying pressure, very few bull bars, usually the reversal up will not get very far. Usually the reversal up is minor, and it will result in a trading range. But once you have a trading range, you then can get another attempt at a major trend reversal. You can also call this a wedge bottom, 1, 2, 3. A wedge is a channel. I could draw a line across these lows, and this is a bear breakout below a bear channel, 75% chance you'll get a reversal up. It's also a second failed breakout above this low. Tried to break out, and it looks like it's trying to fail. We have a pullback, and then we're trying to reverse up again. A second time the breakout below this low is failing. It's a higher probability buy. 2-bar reversal, good looking bull bar, and it's a reasonable buy. Is it a true major trend reversal? It might not be because this channel is so tight. However, it's a reasonable try. And then this rally had 6, 7, 8 consecutive bull bars. We have gap bars. If the bear trend tries to resume again, odds are we'll get another attempt at a major trend reversal. For example, here, a higher low major trend reversal. This is a test of the buy signal high and a good reversal up again a second time. Traders bought above this bar, got a strong rally. we're coming down to that price again, and they're buying again. Here's an example of a major trend reversal that led to a trading range instead of a bull trend. Remember, only 40% of major trend reversals result in swing trades. 60% result in a small profit or a small loss. And during those 60% of trades, usually your overall profit picture is break even. You lose some, you win some, and the wins and losses cancel each other out. But you need that 40% of the time creating swing trades to make the strategy profitable. Whenever there's a bear trend, you should always be drawing lines. It's a reminder that if we break above the bear trend line and then the bear trend resumes, that resumption might be the end of the bear trend. A bear trend, draw a line. Is this a major reversal? Is this a major reversal? No, not much buying pressure. Probably a minor reversal, which means either a bear flag or a trading range. It's a minor higher low, not a major higher low. Another reversal down, draw another line. Does this look like enough bars to lead to a major trend reversal? No, it's probably simply a minor reversal again. So the low that you get afterwards, probably not going to be a major reversal. You can say we have a bear trend and all of this is the break above the trend line, and it is. However, a very tight bear channel, just like this is a very tight bear channel, when you have a very tight bear channel, usually the reversal up is minor and the bear trend resumes. Very tight bear channel, the reversal up is minor and the bear trend resumes. And here we ended up simply staying sideways. Lower low, major trend reversal. Bear trend, break above the trend line. Resumption of the bear trend, and it's reversing up again. But very tight bear channel. Not much in terms of buying pressure, not many bull bars. Probably this reversal is minor, and it probably will lead to a trading range or maybe even another bear flag. Reversal down, draw another line. The market broke above the top of the channel. So when the market gets down near the low, look for a reversal up for a possible major trend reversal. Moving average gap bar, a sign of strong bulls. Several bull bars closing near their highs, a sign of strong bulls. The bulls were able to own the market for about 8 bars or so. That's pretty good. Maybe they'll be able to stop the bear trend and either convert the bear trend into a trading range or into a bull trend. When you see the bear trend resume, maybe the next reversal up will lead to a major reversal. Again, lower low, major trend reversal, but a very tight bear channel, not many big bull bars. Probably this is going to be a minor reversal as well, leading to a trading range, a deep pullback. You can start the process over again and draw a new bear trend line and look at this as the break above that bear trend line. We have a series of gap bars here. Next reversal down probably will result in another major trend reversal attempt. And it did, and you'd buy that. The bear trend is resuming. So bear trend tried to reverse, bear trend is resuming, but it reverses up again on the test of the original entry price and a test of this low. It's a major trend reversal, a reasonable buy. Yet it resulted in a trading range and end of the bear trend instead of a reversal into a bull trend. Remember, only 40% of the time will a major trend reversal actually lead to a major reversal into a swing up or a bull trend. Whenever you have a lower low major trend reversal or a double bottom major trend reversal, you're expecting at least a couple legs up, 1 pullback 2, and that pullback is therefore a higher low major trend reversal. When you get a higher low trend reversal, you really only are expecting 1 leg up because you've already had a first leg up. You're getting a reversal, first leg, pullback, second leg. That's the minimum objective. If you take the lower low major trend reversal entry, you expect 2 legs up. If you take the higher low major trend reversal entry, you may only get 1 more leg up. So you have to make decisions on what to do with profit taking. I want to talk a little bit about head and shoulders patterns. We have a bull trend. I can draw a trend line. I can draw a trend line that way as well. And I have a lower high major trend reversal. Here I have a higher high major trend reversal. Every head and shoulders top is a higher high major trend reversal and then a lower high major trend reversal. It doesn't matter whether you call it a head and shoulders top or a major trend reversal, but anytime you see a head and shoulders top, you know there was a higher high major trend reversal and then a lower low major trend reversal. The lower high, it means the bulls were not strong enough to get above the prior high. So weak bulls, and you have to assume either the bull trend is ending or pausing, maybe we get a trading range, or the bears are strong enough to create a bear swing. A bull trend needs higher highs. If you get a reversal down from a lower high, you have to be thinking that maybe the bull trend has ended. Another bear trend, I could draw a trend line here. I could draw a trend line there, the top of a channel. Left shoulder, head, right shoulder. It's a major trend reversal and it's a head and shoulders bottom. The left shoulder has a small double bottom in it. The head has a small double bottom in it. And the right shoulder here, right shoulder, or you can call this a double bottom right shoulder. The market broke above a bear channel and we got a lower low major trend reversal. We broke above another trend line and now we have a higher low major trend reversal. Every head and shoulders bottom has both a lower low major trend reversal and a higher low major trend reversal in it. The bears failed to make a new low, so the bears are getting weaker and the bulls are getting stronger. A bear trend needs lower lows, and if you get a higher low, you have to be wondering if the bear trend has ended and the market has converted into a trading range or into a bull trend. Nested patterns, a pattern within a bigger pattern, are common, and they're especially common with head and shoulders tops and head and shoulders bottoms. Here we have a head and shoulders top, a weak bull trend, left shoulder, head, right shoulder. But look at that left shoulder. Within it, there's a smaller head and shoulders top. Hard to see the right shoulder, but there it is. And look at the head. Left shoulder, head, right shoulder. So there's a small head and shoulders top nested within the head of a larger head and shoulders top. And the right shoulder itself subdivides into a smaller head and shoulders top. Left shoulder, head, right shoulder. Very common to see nested patterns in head and shoulders patterns. Head and shoulders bottom, left shoulder, head, right shoulder. The left or right shoulders and the head often contain double bottoms. Here we have a double bottom for the left shoulder and for the head and for the right shoulder. And you could also call this a small head and shoulders bottom, left shoulder, head, and right shoulder. So we have nested reversal patterns. Within the large head and shoulders pattern, there are smaller reversal patterns as well. A bear trend, a bull break, mostly going sideways for about 20 or 30 bars. Tight trading range. Major trend reversals often contain double bottoms, especially when the break above the channel is a tight trading range where the market goes sideways. There's often a double bottom in there, and that double bottom is a double bottom higher or low major trend reversal. Whenever you see a tight trading range breaking a bear trend line, look for a double bottom. Double bottom, buy the reversal up. Probability, only 40% chance you'll get a swing up, but the risk is small. You're buying above here, stop below here. Major trend reversal top, there's often a double top within it. Here's a head and shoulders top, left shoulder, head, right shoulder. Can you call this the head? It doesn't matter. You got to push up reversal. A push-up, a second push-up, reversal, and then a right shoulder. Remember, every head and shoulders top is a major trend reversal. Certainly the right shoulder is a lower high major trend reversal. Sometimes the head is not major. For example, if you call this the left shoulder, right shoulder, is this a lower high? I don't know. To me, this is not a major reversal. This could be bull trend, bear break, and then a test of the old high. Most computers would read this as a head and shoulders top with this the left shoulder, and then the head having a double top, and then this as the right shoulder. You can call this a double top, you can call it a wedge, 3 pushes up here, 1, 2, 3, or 1, 2, 3. So it's nested as well. There's a smaller reversal pattern within a larger reversal pattern. It's also a triangle top, 3 pushes up, 1, 2, 3. Triangle is a breakout mode pattern. It can lead to trend resumption up or trend reversal down. Again, the right shoulder is a double top, left shoulder is a double top, the head is a double top. So you have nested reversal patterns, smaller reversal patterns within a larger reversal pattern. A bull trend, a bear breakout, and then a high, and the high is followed by a tight trading range. Whenever you see a tight trading range after a potential top, always look for a double top within it, because that double top can be a double top that leads to a reversal down. Here, we have a high. This double top is slightly below that high. It could be slightly above. It could be exactly at that high. However, whenever you see a double top and a tight trading range after a possible top, you have to be thinking that this tight trading range might be a major trend reversal. You could say the bear trend began here, since this is the high of the entire move, and that would make this a double top bear flag. So early bear trend and then a double top bear flag. I view it as a double top lower high major trend reversal. If you want, head and shoulders top, left shoulder, head, right shoulder, or left shoulder, head, and right shoulder here. It doesn't matter. You have to be aware of what the process is. Don't worry about the terms. We have a bull trend, a bear breakout, a resumption of the bull trend, and it's stalling. And you're in breakout mode. You might get trend resumption up, you might get trend reversal down. Be prepared to sell if it starts to go down. Here we have a strong bull trend, and then we went sideways for about 20 or 30 bars. And we have a double top within that tight trading range. It's slightly above this high. However, whenever you have a tight trading range after a bull trend, and then you have a double top in the tight trading range, you got to be thinking about the possibility of a major trend reversal. Double top in a tight trading range. This time it's a higher high. This is a type of major trend reversal. If you want, you can say bull trend, bear breakout with a tight trading range, and then a higher high major trend reversal that formed a double top. The goal after any reversal, any major reversal, is 2 legs and 10 bars, minimum goal. Leg 1, pull back leg 2, about 20 bars here, 15, 20 bars. That's the minimum goal. It could result in a huge bear trend, but the minimum goal from any major reversal is 10 bars and 2 legs. Whenever the 2 legs are in a very tight channel like this, you have to wonder, maybe this is the first of 2 larger legs down. This might be the end of it, 1, 2, or a tight bear channel. It could be a first leg and then a pullback and then a bigger second leg. And then this is the first leg that's subdivided into 2 smaller legs, and then a strong reversal up at the prior low. All patterns fail, and they fail often. Most patterns fail at least 40% of the time. Major trend reversals only lead to profitable swing trades 40% of the time. That means basically they fail 60% of the time. We have a bull trend, a break below the trend line, higher high major trend reversal, and then an attempt at a lower high major trend reversal. Head and shoulders top, left shoulder, head, right shoulder. Traders would sell below this bar, a micro double top, so a second entry short, maybe sell below that bar. However, we got a bull breakout. The top failed. Whenever you have a major top failing, you have to look for two legs up, one, pull back two. This breakout is strong enough to make traders expect that we'll get at least one more leg up. When you have any kind of a top, 60% of major tops fail. 40% fail very quickly as soon as the top forms. When it does, you look for some kind of measured move up and for two legs, one, pull back two. We have a trading range and a breakout. Whenever there's a breakout, always look for a measured move. A reasonable starting point is the height of the most recent bull leg, and you can see what happened when it got up to that target. The bulls took profits, and bear scalpers probably sold as well. The lower high major trend reversal, the head and shoulders top, it failed when the market went above the lower high. That's where the bears have their stop, just above this lower high. And it's where bulls will buy as well. They know that if the bears get stopped out, we'll probably get a couple legs up, so bulls will buy exactly where the bears are getting stopped out, just above this high. We have a resumption of the bull trend. You have to start the process over again if you're looking for a reversal. You need another break below a trend line, another resumption of the bull trend, and then another failure around the prior high. We have a bear trend, strong break above the bear channel, and several gap bars. Usually leads to an attempt at a major trend reversal after the bear trend resumes. Head and shoulders bottom, higher low major trend reversal. Bulls buy above this bar. They put a stop just below its low. Again, most major trend reversals do not lead to a reversal into an opposite trend. They usually lead to a trading range or a resumption of the bear trend. The bulls who bought this reversal put their stop just below this low, and they'll get stopped out here. The bears know the bulls will do that. They know the bulls will give up, and a lot of bears will look to go short on a stop just below this low, exactly where the bulls are getting stopped out, and traders will look for two legs down. Here we got several legs down. Minimum goal is some kind of a measured move. A good starting point is maybe the top of the most recent bear leg. And then the breakout here and look for a measured move down. We fell for more than that. It fell below the higher low, so the bulls got stopped out. And bears shorted as well. We have another attempt at a bottom, maybe a double bottom, major trend reversal. But this high failed around this breakout point. This rally is probably simply a test of that breakout point. Maybe the measured move, instead of from this low, will be from the height of the entire pattern. And you can see there was some buying down here around that measured move target. So some bulls were buying for scalps and some bears were taking profits or partial profits. The bear trend resumed. If you're looking for a reversal, you have to start the process over again. You need another break above the trend line and then a resumption of the bear trend, and you look for the resumption of the bear trend to fail around the prior low and then for another reversal up. We have pretty good buying pressure in this sell-off, a lot of overlap, a lack of consecutive big bear trend bars, a lot of reversals, and bull bar here, bull bar here, bull bar here, a second entry buy here. This is a higher probability trade for at least a couple legs up, one pullback two, or one pullback two. This is a good buy. This is a good buy as well. If you want, you can call it a triangle, 3 pushes down, 1, 2, 3, and buy the bull breakout of the triangle. We're trying to get a double bottom major trend reversal here. We have a bear trend, a bull breakout, maybe a gap bar here. The next leg down might be the end of the bear trend. Very tight channel, might be simply a minor reversal, but now we have a small double bottom and a bigger double bottom. This is a reasonable buy. This is a reasonable buy as well. A pretty good first leg up. Bulls probably would put their stop below that low. However, they would be concerned that we're getting a reversal down and then a second reversal down and an expanding triangle, 1, 2, 3, 1, 2. So the bulls are concerned that this might fail. Bulls would either get out below that bear bar. If it started up again, they'd buy again, or they'd put a stop below this low or that low. And you can see we broke below, big bear breakout, probably at least a couple legs down, 1 pullback 2 or 1 pullback 2. In any case, it's a failed bottom. The bear trend is resuming, and you got to start the process of looking for a bottom over again. Bears will sell. They'll sell below this low or below that low, and the bulls will give up below that low. Start the process over again. Bear trend, draw a trend line there, or simply draw a trend line here. And then we got a bull breakout, very good bull bar, an additional good bull bar, and then a small triangle for a higher low. Small, higher low, major trend reversal, very good bull breakout, decent bull bar here, buy on a stop above that high. Minimum goal is 2 legs up, 1 pullback 2, and 10 bars up. So we got 10 bars and 2 legs. Minimum goal. This breakout is so strong, probably at least a little bit more up. We got a little bit more up here, but now the bears are thinking maybe a double top major trend reversal. Bull trend, bear breakout, double top, slightly higher high. And bears might sell here. And it broke below the neckline of this double top, but the bear breakout failed. And the bulls will look to buy a resumption up. An ABC pullback, A, pullback B, a big high 2, 1 pullback 2. Does not matter that the pullback from the first leg down went above the top of the bull trend and the top of the first leg down. Traders will look at this as a failed bear reversal attempt. Tried to reverse down here, double top, major trend reversal. Tried to reverse down a second time and failed. Bulls will buy above here or above here, viewing this entire thing as a bull flag from this very strong rally. The bulls who bought the major trend reversal look for 2 legs up at a minimum, 1, 2, they get 3, 4. Sometimes you get many legs up. I began by talking about major trend reversal bottoms, leading to 10 bars and 2 legs up as a minimum goal. The bulls get their goal of a swing trade up about 40% of the time, but the reward is often many times bigger than the risk, and therefore the trader's equation is good. I then talked about head and shoulders reversal patterns. Every head and shoulders top has a lower high major trend reversal in it, and the head often is a higher high major trend reversal. Every head and shoulders bottom has a higher low major trend reversal, and often the head is a lower low major trend reversal. Finally, I talked about failed major trend reversal patterns. If the stop gets hit and the breakout beyond the stop is strong, traders will cover and opposite traders will look for a couple legs in a resumption of the original trend. The reversal pattern is failing. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 4th of 4 videos on major trend reversals.